So, with the housing market as it is in America right now, are we going to finally see more first time buyers with the possible 50-year mortgage?
Well, home affordability is a big issue. It's been a topic for a long time and it recently became a bigger topic, right? They're talking about a 50-year mortgage. Me personally, I'm not in love with the 50-year mortgage. At the same time, I think that in general, people say anything new is sometimes uncomfortable. However, here are my thoughts on a 50-year. I do think in the short term, it would help people buy a house. In the long term, though, it's not going to help with affordability. It is not going to help build wealth, and it's probably going to slow home sales down because it won't help people move up and buy a bigger house in the future. So because people won't be building any real equity, it's going to be harder for them to buy another home when they're ready to make that next step.
So, it's great in the immediate, but not in the long term.
I think it's a short-term solution with some long-term negative consequences.
This is what we're going to be talking about today with the loan doctor, Richard Brandt, and yours truly, I am Giselle Andres. So here's a couple of questions for you. And I kind of delved into this 50-year mortgage, which you're more familiar with than I am. In today's affordability problem, which you already touched on, is the problem that we're having currently tied to interest rates. Is that what caused all of this upset? Or how much is tied to pricing, inventory, policy?
Well, I think as with anything, there's whenever you have a significant problem, there's very rarely one thing that's the cause. It's a culmination of things, right? We've had the fact that prices have increased. We have a shortage of housing. We definitely have a shortage of affordable housing, and the interest rates as well. So I think that is a perfect storm, if you would, to get us in the situation that we are now. We do need to do something about affordability, and hopefully the people who are responsible for making those decisions will do the right things.
Is it possible, though, if interest rates go down and home prices perhaps are also more affordable because of a 50-year mortgage, more people will be able to purchase one?
Well, again, in the short term, it'll help more people buy a house, but it won't increase wealth. That's the thing about real estate, right? Is why rent when you can buy? And the purpose of buying is because you generate wealth. That's the whole idea behind the American dream. Why do I want to own my own home? Because I'm going to own my own home. I'm going to not pay rent. I'm going to build wealth. And with a 50-year mortgage, you're not really going to build wealth if all you're doing is making that minimum payment.
So, what is the real advantage of it?
Again, it's in the short term, it helps you buy a house. I talk about like first time home buyer programs and down payment assistance programs. Down payment assistance programs are great for people who need them.
Hmm.
They're not great for people who just want them.
What is the difference between what more people think the first time home buyer program is and what it actually is?
Well, I think most people think that a first time home buyer program is free money. And it's really not free money. There is a benefit, and that's why I focus on that need and that want.
Hmm.
For the right person in the right situation, a first-time homebuyer program can be the difference between them getting a house and not getting a house, and then it has purpose. But if you're thinking that I'm just going to get free money from the government or free money from somebody else, that's not really what they do, because it's not free. There's no such thing as free money. And so touching on the 50-year mortgage, in the immediate future, it is going to help people buy a house. That it will do. And so for that reason, it's good. But if there isn't some kind of implementation to make sure that they're not staying with that 50-year term, that they're not doing something to increase their principal over time, that then you're going to have that situation where people aren't building equity.
Now, on an example, a $500,000 house, how much would the payment difference really be between a 30-year and a 50-year?
Again, it depends on the rate and stuff like that. Typically, if we do a 50-year, it's probably going to come at a higher rate than a 30-year.
Why
if
is
that
that?
were to happen. Well, the same reason that a 15-year has a lower rate than a 30. From an investment standpoint, a 30-year fixed rate is a hedge against inflation, right? It's for a very long term. The bank is committed to giving you a loan at this rate, regardless of what the market might do.
So if it all of a sudden
Right.
skyrockets, they're
So,
stuck.
so now, right. So now doing that for 50 years is an even greater risk. And if the bank is going to do something that has more risk, they're going to want to increase their return. So the rate's likely higher. But to answer your question, on $500,000, the payment difference is probably about $300
Every month.
on $500,000. Yeah, but it's $300, but you're paying it for 20 more years. So what you're going to end up paying is typically when you buy a house, if you were to stay the entire term, you're paying about 2.5 times what the house is worth at today's dollars. On a 50-year, that's going to go to 3.5 or 4 times.
Wow.
Yeah. Again, a 50-year for the right situation, it's not the end of the world as long as there's something in place to get people to sort of build equity after.
But if they don't stay in the house for 50 years and they sell 5 or 10 years in, do they have any equity built up?
Not a whole lot. If they've haven't been making extra principal payments, they have not built a lot of equity.
What is the risk to the lender when they take on a 50-year? Just the interest rate changes that could occur, or are there others?
Yeah, no, that would be the risk, and I think if you think about it like this, is if part of what goes into the home ownership process is the fact that you have equity, right? So in the event that something were to happen, right, a bank, and we experienced this in the early 2000s, but a bank doesn't want to foreclose, right? A bank wants to make sure that they're able to help you through the tough times and stuff like that, and they're going to work with you.
Yeah, they're not in the home buying business.
Correct, right, or the home owning business, right? They're in the right, but I think one of the things that would happen is if people didn't have any equity, and they were having a hardship, it would be a lot easier for them to walk away, and you would probably result in having more foreclosures.
Now, I like the way you just said I said home buying, you said no home owners, but that's what you do. You turn home buyers into home owners,
That is exactly right.
right? On a personal note, that's
On a
what you
personal
do.
note, that is what we do.
For a 50-year mortgage, what would need to change in underwriting?
I mean, it depends, what the legislation does, but on a 50-year mortgage, the underwriting would probably be pretty similar to what it is now. I don't think there would be an impact. I don't think that would be one of the things that changes.
You don't think age would be a factor?
No, actually, you couldn't do that. Age can't be a factor.
That's why I
Yeah,
know
yeah,
that,
yeah.
but I'm saying
I
when
got
you
you.
extend it to 50.
When you extend it to yeah, but so here's the thing, an 85-year-old person could get a 30-year mortgage because you can't discriminate based on somebody's age. Okay, if that's the case, then an 85-year-old would be able to get a 50-year mortgage. And people are living longer, so in 20 years, a 115-year-old would also be able to get a 50-year mortgage.
Goodness. See, that seems silly to me, and I think to you too. But legally speaking, that is the case.
A 30-year mortgage isn't necessarily a 30-year mortgage. It doesn't mean that somebody's going to have it for 30 years. It just means that that their monthly payment is based on a 30-year time schedule. Right? That's all that it means. Somebody who's 85, if we're going to talk about it, might only have their house for 5 years, right? The expectation isn't that they're going to outlive their mortgage. Let's hope, God, let's hope they do. But that's probably pretty unlikely. So that's a 30-year mortgage is not necessarily a 30-year term. It's just a 30-year payment type.
Would a 50-year mortgage appeal more to first-time buyers, maybe high-cost markets, or investors?
Well, so a 50-year mortgage might appeal to it probably first-time home buyers. It could appeal to investors only because it would help improve cash flow, like immediate cash flow. They're not really building wealth, which is kind of one of the reasons why they buy investment property anyway, to have their equity, increase their equity. But if somebody else is making the payment, maybe an investor would be okay with it. The other people who might be okay with it are senior citizens who aren't looking necessarily to, let's say they have equity and they want to refinance, but switching to a 50 is going to drop their payment and make their home a little bit more affordable, and they don't really care about the equity.
Could somebody refinance to a 50?
Well, I don't know. It depends what the legislation does. Yeah, that's above my pay grade.
Because that would definitely be a way to trick the system a little bit, right?
Well, I mean, I think that's some of the things that would happen is you would be, if it wasn't just for a purchase, then you would have people be doing that.
Now, could this lead to higher home prices overall?
Probably.
Why?
Well, I think what would happen is if you make people's monthly payment lower,
It increases demand.
it increases the number of people who could buy. And so now you're increasing the buyer pool. And if you're increasing demand and not increasing supply, you have a price increase.
Now, one of the other things that has been talked about is the possibility of taking your current interest rate into a new property.
Yeah.
Maybe that would fix the housing market problem.
Well, I don't know if that's going to fix the affordability crisis for people who are looking to buy their first home, right? One of the things that's happening is the cost to go from no ownership to home ownership increases virtually every year, right? So that's not going to impact that at all. The other challenge that you have is that if you have this equity, or you have a mortgage and you're buying another house with that's more money, right? Let's say you're going from I have a house that's worth $500,000. I've got a $200,000 mortgage. I'm taking that mortgage with me. What am I doing with the house that I have now? Am I refinancing it at today's rates and then I'm at the same place? Am I selling that house and now I'm reducing the amount of investment property or the available rentals?
You're also forcing the bank into a very inconvenient position, aren't you?
Well, not so much because then what happens is kind of like what we were talking about before. A 30-year mortgage isn't really designed to be a mortgage that exists for 30 years. It's just a 30-year amortization. If you allow people to move with it, then now this mortgage that isn't supposed to be a vehicle that lasts for 30 years is lasting for 30 years. But the other problem that you have is that the difference in equity. If I'm buying $1 million house and I've only got a $200,000 current mortgage, what's my second mortgage going to be for the 800? How am I making up the gap? Am I coming up with $800,000 in cash? Am I getting a mortgage for part of it? What's that rate going to be? And so there's a lot. I don't know if that's the solution. I think that's got a lot more to work out than even the 50-year.
Well, I think that we can agree that there is a housing market problem,
Yeah.
right, in America.
Right.
If you had a crystal ball, which is probably the worst way to start a question to any professional, but if you had a crystal ball,
Well,
what do you think would be something that's workable and fair?
I actually wish we did this interview last week because I did have a crystal ball and it's in the shop.
Oh, it's broken today. Oh, gotcha.
So since I don't have my crystal ball with me today,
Right.
what do I think is going to happen?
No, what do you think could be fair?
Um,
What is something workable?
that's tough.
That's the $1 million question.
I think that's the thing that everybody is struggling with. And I know I talked about this on a previous Loan Doctor podcast that we did, where in my opinion, and I don't have a say, it's not up to me, but if anybody who does have a say is listening and you think this idea has merit, maybe you could do something about it.
And you're allowed to lend it like that?
Well,
You're giving it
again,
away.
I'm giving it away that says, hey, this might help with the solution. What I would like to see happen is I would like to see us do something called the temporary buy down, where we have a temporary buy down now that exists, where what a temporary buy down does is you're lowering the monthly payment based on a lower interest rate for a period of time. So
how would that work on using the $500,000 house example?
okay, so on what is called a 2-1 buy down, what you're doing is you're making a payment that is based on a rate that's 2% lower than your base rate. So if the base rate is, let's say, 6.5, right, and you have a 2-1 buy down, the first year your monthly payment would be based on a 4.5% interest rate.
Okay.
Okay. The next year it would be based on a 5.5% interest rate.
Okay.
And then the third year and the remaining 27 years would be based on that 6.5. Okay.
Okay.
What happens now with a temporary buy down is the homeowner, the buyer, has to qualify at that 6.5% rate and not at the lower rate. What I would propose is that you make it a 5-year buy down, and you allow them to qualify at the lower rate so that you make the homes more affordable. And the reason that I think it's viable is because it's likely that over the course of the next 5 years, right, the person who uses it is going to be making more money than they're making today.
But who takes the hit? Is it the bank?
Well, that would be whether or not there would be incentives from a government aspect or something like that. Again, it's not my decision to make, and I know they're trying all kinds of different things and stuff like that. This would just be my suggestion, and I haven't worked out like who's going to be fiscally responsible for that difference. But I'm sure there would be ways to incentivize and stuff like that. The other thing I wouldn't do is I wouldn't make it available to everybody. It should be designed to help people who need it, and that's what it would be good for.
Now, I know at another Loan Doctor podcast, you discussed very lightly what it is that's going on, politically speaking, across the nation. You do mortgages in all 50 states. So you must deal with the different property taxes, different insurance payments, different conditions, different laws and bylaws, because you need to know these things. Is there a section of the country that's a little bit easier to buy in than others for a first-time buyer? Like, I have 2 college-age children,
Right.
and they both would love to own a property. They haven't yet. Is there a section in this country where it's a little bit easier for them?
Well, I mean, there are places in the country where the home prices are lower, right?
Yeah.
So that that's going to make it a little bit more affordable in terms of like loan qualifying. I don't think there really isn't, mortgage qualification. The mortgage qualification process is really a national thing. There are some nuances, when it comes to insurances. In Florida, you have a little more HOAs than most places. Property taxes vary and things like that. There's also different things, different costs associated with mortgages and stuff, or getting financing or buying real estate. But I think that if you're looking at, are there places that make it easier for somebody who's a first-time home buyer? Probably someplace that has lower priced homes, as long as it doesn't also have lower priced salaries.
Yeah, because that's a big issue here in Florida, is that our home prices have kind of surpassed our incomes.
Well, again, that's the reason we have an affordability crisis, is because homes are, the home values are not keeping up with people's increase in income.
Now, across the nation as well, we're looking at the changes as in real time. For 2026, do you see the market changing in a particular way that we can take advantage of when it comes to housing?
I'm not a big predictor. I think, stuff happens and people are, no matter where interest rates go, people are going to outgrow the space that they're in, and they're going to either have to move up or they're going to have to, create more space in their house by expanding or things like that. So, people are going to relocate for their job and stuff. So I think activity is going to happen no matter what. And if rates go down, you're probably going to have more activity. If rates go up, you're probably going to have a little bit less activity. I kind of focus more on the here and now than trying to predict what might happen in the future. And I think with anything, trying to time the market, whether you're buying stock or you're buying real estate, timing the market is kind of risky. If you're able to find a property that you like, that you can afford, buy it. If the cost of owning that property becomes cheaper in a year from now because rates go down, then you refinance. You don't have to stay in the loan forever.
Yeah, I loved an example that you told me about Apple stock or
Yeah.
any stock for that matter. We just talked about Apple, but if I told you, "Hey, can you tell me the price of the Apple stock in 30 days?" You can't. You can't guarantee it. It'll go up or it'll go down or it'll stay flat. You just don't know.
I think one of the questions that I get asked a lot when somebody is in the middle, they're about to start the home buying process, but they don't have a home yet. They're just shopping and trying to pick the right lender, right? And they ask me, "What are your rates?" Right? They don't have a
That's the first
house,
question from everyone.
right? They don't have a house, and what I tell people all the time is, as weird as it might be to as it might sound, right now, before you have a property, your job should be to find the right lender, the person that you're comfortable with, the person's going to look at the pieces of your financial puzzle and be able to take you across the finish line. And not that you want to not worry about the rate, but the rate isn't the most important thing at the moment. And the reason is because the rate, we don't know what the rate's going to be by the time you buy a house. And like you said, if somebody called me up and said, "Hey, I need you to tell me how much Apple stock is going to be 30 days from now," I'd be like, "I don't know.
Yeah.
I could tell you how much it is today."
Yeah. My partner and I want to
Right.
buy a house next year. What's your rate? Well, I could tell you what today's rate is, but I can't tell you what's going to be next year.
Well, here's the other thing. I could tell you what today's rate is, and my number today might be cheaper, might be lower than the guy down the street's number today. But that doesn't mean that my number in 30 days is going to be lower,
Hmm.
right? We don't know, because the other thing that you don't know is you don't know if you're calling me, right, and you're asking me what my rates are, and I know that you're not buying a house for 30 days, right? I'm still going to give you what somebody today would get a rate on. But is another loan officer going to give you some number that is really, really low, so that even though they know that there's nothing you could do, you're not locking that rate in. They're giving you an artificial number, right? And it happens all the time. Right now, a 30-year fixed rate, for somebody, with really, really good credit, putting 20% down is like,
Yeah.
let's say 6 1/8.
Yeah, I went on the internet and I went
Yeah,
cha-cha-cha-cha,
yeah.
and this is how come you're not
Okay.
giving me the same thing I
No, no.
I found on the
Right.
internet?
Well, that's a whole different question. But if rates today are 6 1/8, right, and you're not buying a house until 30 days, and I tell you today's rate, and there's nothing you could do about it, I tell you today's rate's 5.75, right? You don't know. So now you just assume that the person who told me 5.75 is, one, giving me a real number,
Mhm.
and two, giving me a number that they're going to give me in 30 days from now,
And it's a
right?
superior number.
Right, but there's no guarantee, and that's why it's kind of what the idea is, that what you want to do is find the right lender. Once you find a property and you lock into a rate, and you want to compare, then compare, because
So
then
step
then you're
one,
comparing with a real number.
let's say my daughters are out there and
You know.
they finally, saved up enough money to be their first time.
Yeah, they want to get pre-approved, and they want to get the lender, whether it's me or anybody else's, should give them the other thing that everybody should get is not just a rate. Rate and cost go hand in hand. So anybody who's shopping for a home should get a full loan estimate, a loan illustration, whatever you want to call it, that not only breaks down how much is my monthly payment going to be, what my interest rate is, but also what are my costs, right? Because that's really how you get a
When
good
you say
breakdown.
the cost of a loan,
Hmm.
what does that mean?
So it essentially means like the closing costs, and the closing costs could be things like origination fees, discount fees, underwriting fees. You've got title fees and all that, escrows.
Appraisal survey?
Yeah, of course, of course. But what happens is, if I tell you that, if right now my rate is 6 1/8
Hmm.
with 0 points,
Great.
okay? If if you get a quote from somebody else and he tells you, "Oh yeah, our rate's 5.75," but he didn't tell you the cost.
It might have had,
It
I might have had to pay a point.
or more,
Mhm.
right? So if you're comparing a rate without comparing the cost for that rate, then it's
Ask for the
you're not,
breakdown is what you're
yeah,
saying.
you're not getting a true sense of the difference,
The
right?
transparency
That's
that you
why,
offer.
right. That's why APR is so important. APR is a measure of your interest rate and your cost kind of together.
What is APR?
APR stands for annual percentage rate.
And is that the
And
same as the Fed number?
no, no, no. APR is the way that it's defined is the true cost of borrowing money. And when I explain it to people, I usually do it using $100 increments, just so people can kind of make sense of it. Let's suppose I give you I lend you $100, and you pay me interest only at 6% interest. And at the end of the first year, you would pay me how much dollars?
Well, $6.
Right. And at the end of 10 years, how much would you pay me?
I would think 6 times 10 is $60.
Correct. Right. Now imagine before I gave you the $100, I made you give me $1.
Okay.
Right. So before I gave you the $100, but your cost, right, your origination fees, your appraisal, whatever, cost $1.
Okay.
Right. So you gave me $1. Right. At the end of 1 year, what would your APR have been if you paid the loan off in 1 year? It'd actually be 7%, because I gave you 100, right? The math's a little different, but we won't get into that. Just go with me on this. I gave you 100, you gave me 6 plus the dollar. That's 7. So your APR was 7%, even though your interest rate was 6.
That's interesting.
Now
That is so true.
Now take the loan out 10 years. You paid me 60 plus 1. So that's $61. So it wasn't 7%. You didn't have a 7% APR. Your APR was 6.1.
Right.
Okay. That's what APR is. And so when you get an APR from a lender, that's what you're comparing it. You're comparing the rate and the cost. And one of the things that you want to do when you're comparing lenders is compare the same rate between lenders. Which lender at that rate has the better APR? Because if I give you a 5.75 rate, my APR is going to be lower, even though my fees might be astronomical, because my starting point's lower.
Now, the way I asked you about the Fed number, and the reason I did is because I think for practical reasons, most people say, okay, well, it went down 0.25. So how come you're still offering me that quarter point when he said that it went down 0.25? How come you didn't go down 0.25?
I gotcha. So when you're talking about when the Federal Reserve, when the Fed lowers the rate or raises the rate, they're really talking about the prime rate, and the prime rate is an indication of short-term interest rates. Short-term interest rates are for automobile loans, personal loans, credit cards. Those are the things that are affected.
And those change immediately?
And they would go up or down relatively immediately. In some cases, like for somebody that has like a home equity loan that's tied to the prime rate, a quarter when the Fed says your rate's a quarter lower, the next month your HELOC rate is a 0.25% lower. But long-term interest rates are not based on prime. They follow the same direction, but they move a little bit slower. And they're also based on speculation. So one of the things that happened recently is rates started to trend down even before September, when the Fed made their announcement to lower their first rate reduction, because the speculation was this is what they were going to do, right? And the speculation was they were going to have 3 of them. And so we're still expecting another one by December of this year, of 2025. But when that happens, the 30-year fixed rate loans aren't going to change that much, because that speculation is already built into the pricing today.
That makes perfect sense. So you are Richard Brandt, the Loan Doctor podcast, and you're very humble about how you are in the top 1%. But with this, I'll finalize. Why is it important to choose a lender that is in the top 1%?
Well, I mean, I don't think experience is the only thing that you use to sort of judge, right? I think there are a lot of competent people that don't necessarily do the volume that we do, um, but at the same time, sometimes what happens is we're taking the pieces of your financial puzzle, and you never know when you might need the expertise of somebody who's seen it, done it, right? And so if I had a choice and I'm making the biggest purchase of my life,
Hmm.
and I'm deciding between giving a loan to somebody who is learning on the job or giving a loan to somebody who's done it before, I think I would be a little bit more comfortable with somebody who's done it before.
I agree. Plus, since you and I have spoken off the air so many times, I understand that even in my own home, you would have found areas in my loan that could have saved me thousands of dollars, something that was never brought to my attention for the simple fact of maybe that person was inexperienced.
Well, I do think it's important to make sure that you're in the right loan program. Being in the wrong loan program can cost you thousands of dollars. And I think that a lot of times people get exactly what they ask for when their situation calls for something different. And it takes an expert to say, hey, wait a second, let me explain why this might be a better option. And then if you see the value in it, which many people do, they go, oh yeah, that makes sense. Let's do that.
So, Richard Brandt, thank you so much today for allowing me to take your seat because you're usually the interviewer. And, and I kind of sat you on the other side. I was the driver, you were the passenger today.
Well, for everybody who's listening, thank you for being in my waiting room.